cheap,
buy,
or expensive.
Sell.
In this market, that's what you need to ask yourself when you're looking at a stock with an incredibly low price to earnings or PE multiple. So many talking heads, particularly those who sat out this amazing bull run, well, they feel the need to tell you how expensive this market is. They're typically looking at the price to earnings multiples of stocks like Church & Dwight or Coca-Cola, Clorox, which you covered earlier. Or they go even bigger and they say, hey, Cramer family fave, Okta, Workday, ServiceNow, Coupa, Zscaler, RingCentral, Zendesk, to name some that come to mind instantly. I respect that. I'm not saying those stocks are cheap. They're very expensive. But right now, you can find a tremendous number of household names that aren't expensive at all. In fact, they're total bargains as long as we don't have a recession. And then all bets are off for some of these. First, the automakers. Ford sells for 6 times next year's earnings. GM, 5. That's so cheap, it's frightening. When you see this kind of ultra-low multiple, it tells you that investors believe we're headed for a recession, plain and simple. Perhaps within a couple of quarters. If we get a recession, the earnings will fall apart, and these stocks will turn out to be a lot more expensive than they currently look. In Ford's case, also, its dividend, bountiful 6.8%, would be presumed to be cut. That high yield is another warning sign telling you something's got to give. If there's no recession, Ford and GM could easily be great buys here. So are they cheap or are they expensive? Too hard to tell, at least for now. They could be the ultimate value traps. Another example is Micron, the commodity chip maker. I've said over and over again that Micron's the key to this tech market because it reported a really good quarter, but then it gave disappointing guidance for the next quarter, albeit not for the full year. Company has a gigantic buyback, which clearly kicked in when the stock pulled back to the low 40s earlier this week. Right now, Micron's trading at just 7 times next year's earnings estimates. Just like with Ford and GM, that means Wall Street believes the estimates are too high. The smart money says the earnings will collapse in 2020. I'm not so sure. I think you can start building a position here every time it goes below 40, 41, but the stock might pull back even to the high 30s, and then just got to buy more. What else? How about this? Goldman Sachs and Wells Fargo are at 8 and 11 times next year's earnings, respectively. Now, that's incredible. Goldman's the premier investment bank, at least if you're still trying to get a job in investment banking. Well, it's also the bank behind the Apple Card, even if Apple, in its advertising, says there's no bank behind the card. Technically, they're right. In reality, though, I think it's a multi-billion-dollar business for Goldman, maybe worth as much as high single-digit billions by next year at this time. Either way, 8 times earnings is an awfully low multiple, and that's one of the reasons why my charitable trust owns the stock. You can follow along why I do by subscribing to the ActionAlertsPlus.com club. Wells Fargo used to be the best-run bank in America. Now it's anything but. However, they just got a new CEO, Charlie Scharf, late of Visa and Bank of New York, who's known for his love of technology, his discipline, and expense control. If you ask me, those are the 3 things Wells has been the worst at. I think both of these cheap bank stocks could be huge by the end of the year. Yes, I think they're going to go higher, certainly into next year. Now, finally, there's the retailers. These are tough. Kohl's sells for 9 times earnings. Macy's sells for 5 times earnings. Kohl's has a 5.7% yield. Macy's has a ridiculous 10% yield. Again, both stocks are trading like we're going into a recession, if not, in the case of Macy's, a retail brick-and-mortar depression. I think the market's judging all these stocks way too harshly. Those valuations are right if the economy's about to fall off a cliff, but they're very wrong if business is just going to be okay. It's dealer's choice, people. You're the dealer. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.